With the proposed changes on the horizon to the gift tax exclusions and applicable credit, it's important for practitioners to dust off their knowledge of the gift tax look-back rules. Now, these are often understood, and from an economic perspective, the only real look-back that pulls anything back into the gross estate is payment of gift tax out of pocket. For other purposes, lookbacks just disregard certain transfers or releases that happen within 3 years of death, such as retained rights under Code Sections 2036 through 2038, life insurance incidents of ownership that are gifted, or certain elections that are dependent on the post-gift value of the adjusted gross estate. For non-taxable gifts that are not reported on a gift tax return, other than life insurance, those typically will not be subject to the 3-year look-back period either. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. For today's episode 179, we're going to dig into the gift tax look-back period. Now, as always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. And if you would like a copy of these slides, please email me at griffin.bridgers@gmail.com. Now on to our presentation. So, it's a common misconception that all gifts within 3 years of death are pulled back into the gross estate, or that there's a 3-year look-back period. That 3-year look-back period isn't universally applied to all gifts. It only applies to certain types of gifts or to gift tax itself and to transfers and releases. So today we're going to break some of these down, with the context that this may become more important if the gift tax exclusion is reduced, because first off, a reduction of that exclusion is going to increase gift taxes paid. Now, gift taxes that are paid out of pocket within 3 years of death are always pulled back into the gross estate. Now, right now, it's rare that gift tax is paid out of pocket because that only happens once you exceed your annual exclusion and once your gift tax exceeds your applicable credit. So in other words, once your gifts exceed both annual exclusions and the $11.7 million exclusion. But in the worst case, for example, if the gift lifetime exclusion is reduced to $1 million, you can see there's going to be a lot more gift tax paid out of pocket. Now, this seems confusing and seems tax neutral, but there's actually a benefit here. Since the gift tax is tax exclusive, that means that in addition to the gift that's removed from your gross estate, you're also paying gift tax, which essentially creates a tax-free way to reduce your gross estate. So, gift taxes paid out of pocket are more beneficial than waiting and paying estate tax at death due to the tax-inclusive nature of the estate tax. It's hard to see, but if you do the math on that, I promise you that works out. Now, if you don't want to worry about that 3-year rule, one other way you could look at is to use a grantor trust, because, again, if you pay income tax on behalf of grantor trust beneficiaries, that's also not a gift. It's a way to reduce your estate without an additional gift or estate tax being imposed on that income tax you're paying. But grantor trust could be grandfathered or changed in the future based on some of the tax proposals we've talked about in previous episodes. Now, for transfers of life insurance, if you make any transfer of an incident of ownership for less than full and adequate consideration within 3 years of death, that's going to be ignored. So this is really going to be any change of ownership in the policy, but you're going to have to treat it from a gift tax perspective as if it was a full gift of the policy itself based on its unused premium and cash value at the time, the PS58 cost. So where this is going to apply is if you transfer an existing policy by gift within 3 years of death, especially to an islet. So you can avoid this by either purchasing a new policy, if you can get through underwriting, or having an existing policy purchased by somebody else, but to avoid the transfer for value rule, which would subject the death benefit to income tax, your sale should be to a grantor islet. And a problem there is that this could go away if the grantor trust rules are changed. We may lose the ability to engage in this type of planning. So it's important to set up ILETs now and get this 3-year clock running. And there's no partial valuation here like you could get with code sections 2036 through 2038. It's an all or nothing proposition. So if your purchase price for the sale of the policy does not equal the gift tax value or exceed it, then that could cause all of the death benefit proceeds to be subject to estate tax if the policy is gifted within 3 years of death. So you may want to consider a Wandry type of clause to adjust that purchase price if necessary on a gift or estate tax examination. We've talked about retained interest before, code sections 2036, 2037, or 2038, where maybe you've previously transferred property that was subject to the gift tax, or maybe not, but you've transferred property away that's no longer owned by you, and as a result wouldn't generally be included in your gross estate by titling, but instead you've retained certain rights, such as benefit from that property, the control over that property, voting of corporate stock, a reversionary right if someone predeceases you, and even a right of revocation with respect to that transfer. With any of those powers, you're treated as the owner of that property for estate tax purposes if you hold that power at death. So how can you avoid holding that power at death? You can release the power prior to death, but to avoid deathbed planning, any release of a power like that within 3 years of death is disregarded. So in that case, if you're going to make a transfer, retain a right like this, and then release it down the road, you've got to do so with more than 3 years prior to death, which I know you can't predict, but that's one of those onerous tax rules out there. Now, it's important to note that this could also apply to a beneficiary as well. Code sections 2036, 2037, and 2038 are typically only looked at with respect to a decedent who was the donor of a previous gift that's getting pulled back into the gross estate due to a disregarded transfer. But if you have a beneficiary who holds a general power of appointment over a trust, especially a lifetime general power of appointment, then they release it, but afterwards have a power like the benefit, control, voting, reversion, so on and so forth. The beneficiary could also be deemed to have one of these retained right powers under 2036 through 2038. So not only would the beneficiary have to release the general power of appointment, which could be a gift in and of itself, the beneficiary would have to release all those retained rights as well, and would have to do so more than 3 years prior to death. Then finally, there are certain statutory elections which are based on the comparison of certain qualifying assets to the value of the adjusted gross estate, but not taking into account adjusted taxable gifts. Those include things like the special use valuation, where the composition of your adjusted gross estate has to be farmland and farm personal property net of equity to a certain threshold. Same thing with a stock redemption under Code Section 303. You have to meet a certain value threshold over 35% of the adjusted gross estate being composed of that stock. Now, an easy way to meet those thresholds is by gifting away non-qualifying assets that don't take into account those types of composition percentages. So that, for example, if you gift away a bunch of liquid cash, the percent of your estate that's made up of farmland is going to be much higher. Now, it's hard to do that because gifts within 3 years of death are taken into account in determining those composition percentages. So if you wanted to meet these valuation thresholds, you'd have to make gifts within 3 years of death if you're doing so just for purposes of meeting those thresholds. Now, this is going to become really important, especially for the special use valuation discount, because that discount is going to be increased to a base of $3 million with a corresponding reduction to the estate tax exclusion. So you'll see this a lot more often in the future, especially planning for real estate in a closely held business or family farm. Now finally, If you have any gift that's not reported on a gift tax return, it's typically not a taxable gift. That would include annual exclusion gifts, gifts to a spouse, and gifts that aren't other than life insurance. Life insurance, you don't get the benefit of this. But in any of these cases where you don't file a gift tax return because you don't have to due to the type of gift, those gifts aren't going to account against any of those 3-year rules, including the rule that we just looked at for meeting composition thresholds. But this wouldn't be the case for retained rights or powers under Code Sections 2036, 2037, or 2038. So lots of rules to refresh yourself on if you weren't aware of those before, or if you were aware of those before. If you weren't, hopefully that's a good overview and kind of sets the stage for you to go back and refresh your memory or create an education plan on some of those topics that surround gifting. Now, as always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. But thank you for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.